Hello, and this is Vin Shembri, the president of WOWzer Technologies. I want to continue on with Show You the Money, or Show Me the Money. And I'm going to talk about a topic that a lot of small business people really don't pay that much attention to. That's been my experience, and that is financial statements. And being able to read them so that you actually have an opportunity to understand your business much better. Even if you take the word accounting or accountant and so on, which is the person that does and helps you with your books, the word account, if you look at it, what does it really mean? You're accounting for what? For your activities. So it's important to understand how your activities have actually transpired. How have you done? And if you don't look at your numbers in an organized format that is acceptable to the general people out there, then how do you really know where you are? So in saying all that, what should you be looking at on an ongoing basis? And when I say ongoing basis, the least amount of time per year that you should be spending is monthly. But I highly recommend that you know your numbers, if not weekly, even daily. That's really, really important. The three major financial statements that I'm going to be discussing today is the cash flow statement, the income statement, also known as the profit and loss, and the balance sheet. I'll start out with the cash flow statement. Why do I start out with the cash flow statement? Because cash is king. If you don't know where your cash balance is at, then how can you possibly know? And just knowing your cash balance does not mean that you know where you are. On the cash flow statement, what it shows is your inflows and outflows of your cash. And they're divided into three sections. We have what's known as the operation. That means what you're actually doing. Then you have your investment section. So that means where you take money and invest, for example, in materials. Sorry, not in materials, in equipment, in trucks. You know, these are the things that drive your business. It could even be, if you're an e-commerce business, it could be some technology that you're investing in. And the third one is financing, where the money comes from, whether it comes from investors or yourself. These are really important. Okay, so if you do that analysis and you look at it on an ongoing basis, you can see where your money is going in and out. And if you have more money going out than going in, well, you've got a drain on your cash. And that is a proper picture of what's going on. So it's really important to understand this principle. Not to also mention that, you know, it's really important for you to see on an ongoing basis where your cash is. As I said last week, cash is like milk to a baby. And if you don't know where the cash is, then how much milk have you got for the baby, which is your business in this case? It's really important to know this on an ongoing basis. One of the things I take pride in is knowing my cash position. And because we also most businesses use a thing called accrual accounting as opposed to cash accounting, we actually have to be even more on top of it. Because what is accrual accounting? Accrual accounting is, for example, you issue an invoice, you don't get paid right away. You get paid, 7 days, sometimes 30 days, sometimes even longer. So a sale is not a sale until you collect the cash. And that's what the cash statement shows you, because you end up with an accounts receivable, and until you collect it, it's not cash. And until it clears your bank, it's not cash. That's what the cash flow statement shows you, okay? That's the first one. The second one is the profit and loss statement, also known as the income statement. Now that one tells you what? It tells you your sales minus your expenses, whatever they may be. And as I said last week, you have variable and fixed expenses, gives you what we call your net income, or the bottom line, what's left over. Okay. Now, another thing I want you to understand is when you're using accrual accounting, the bottom line, that's not your cash position, because sales, right, in an accrual situation is also accounted for as an accounts receivable. So you may not have collected it. The cash flow statement is the one that tells you where you are in your cash position, okay? This one tells you if you're profitable or not. In other words, do you have more sales than you have expenses? So therefore, you have what we call net income. Yes, there are companies out there that have what we call net loss, and do so for a period of time until, their products, the sales from their products exceed their expenses. And that's fine. I mean, I can name some of the giants that were like that. For example, I know that Facebook was like that. Twitter was like that, right? They didn't have the sales. They built up what? They built up their brand first, and then they added other revenue streams and were able to become profitable. Well, that could be true for you as well, but still it tracks where you are. It really shows you, and it's important to know where you are on an ongoing basis as well. And you should be comparing, this month versus last month, this month versus last year, the same month, to see what kind of trends you have. Are some months higher in revenues than others? How about your expenses? Is that the case as well? For example, if you're an e-commerce business, I guarantee that in most cases, your Christmas period has higher sales than your non-Christmas period. Usually that's how it is. Now, there can be companies, even in e-commerce, that are steady all the way through, and the Christmas period is higher. That's true as well. But you want to know what that is, because come January, the tendency in business is that the numbers are down. But you want to know what that is so you can what? Plan accordingly. Okay? So you could have, as I said, revenues, and you also want to separate the types of revenues. I mean, I have some clients that even though they're in e-commerce, they may have book sales or electronic book sales, and they may do some kind of teaching as well. You want to know what types of incomes you're making and how they're doing. In your case, you may start out with one type of revenue and then expand. And you also want to look at your expenses as well. Now, in some cases, if you take, for example, in the food, you have what we call cost of sales. What does that mean? Cost of sales, or cost of goods sold is another term. Cost of goods, that means it's a physical product, whereas cost of sales is not a physical product. So e-commerce would have what we call cost of sales, and restaurants or McDonald's would have cost of goods sold. And what that is in order to make a hamburger, for example, you have a bun, you have a patty, and you have ingredients. Well, the items that you purchased, those are cost of goods that you sold. Okay, and obviously you want to make sure that you make a profit on it. Remember last week we talked about markup and profit margins? This is where it applies, right? And then you have what we call gross profit. So if you take sales minus your cost of goods, gives you your gross profit or your profit margin. And be careful how you calculate your profit margin. Remember I said you have to divide by what? Sales, gross sales, not your cost. Otherwise, you're not going to get the right percentage. Then below that, okay, and that would be the cost of sales. Those are your variable costs. Below that, you have what we call operating expenses. Those are what? Generally, your fixed costs in a lot of cases. Okay, such as you will have rent if you're leasing or renting a location. You'll have such things as bank charges, because hey, you know what? To have a bank account, you have bank charges. If you borrowed money, you will have interest charges. You'll have that in there as well. If you're delivering, you'll have your vehicle expenses in there as well, and so on and so on. And then if you take your top line, which is your gross sales, minus your cost of goods or cost of sales, giving you your gross profit, subtracting all your other expenses, you have what we call net profit or your bottom line. Okay, and all that information from the cash flow and also from the income statement ends up on your third statement called the balance sheet. That really is the balance of where you are at some specific period of time. The income statement and the cash flow monitor on a year-to-year basis on your fiscal year. Okay, and your fiscal year is not necessarily the calendar year. It can be any time during the year. It could be, but it's one full year, and it could be July 1st to June 30th. And it could be September 1st to August 31st, or it could be November 1st to October 31st, and so on and so on. So it's measured in a 1-year cycle. Okay, that's your income statement, and that is your cash flow statement. The balance sheet is cumulative of what's been going on since the beginning of the company. It accumulates. It's cumulative. Okay. And what it shows you is your assets, what you own, minus your liabilities, what you owe, right? It gives you what we call shareholders or equity. So assets minus liabilities, right, gives you what basically is left in the company. That is your picture of how healthy you are. So what does it show you? So what you look at on the balance sheet is it is a measurement of a moment in time. So if the fiscal year ends in June 30th, the balance sheet will be as of June 30th, whereas the income statement and the cash flow statement are for the year ending. You will notice that in the title as well. So that's 1 year at a time, okay? And also on the balance sheet, you'll see, for example, how much cash you really have. And that number comes from where? The cash flow statement. That's where it comes from. That's why I say those two summarize it, because the profit and loss, net income, shows up in what we call the retained earnings. You retain your earnings. That's why it's called retained earnings. The sum of all the net income and losses. That's on the equity section. So that's where you find them as a one-line item. Okay. And so if you go back to the assets, what kind of assets would you have? We have what we call current assets, fixed assets, and long-term assets. Current assets are such things as, the very first one is cash. Do you have cash? That comes from the cash flow statement. So the bottom number on the cash flow statement ends up on the balance sheet, right at the top. Okay. And you can have such things as accounts receivable. Remember I said in the income statement, a sale is not a sale until you collect it. And what you have not collected goes into an account called accounts receivable. That is people who you've issued an invoice to who now owe you money. Okay, you would have such things as inventories in there as well. That's a current asset as well. What's a fixed asset? A fixed asset would be when you buy vehicles, okay, machinery. And also there's two things that you need to determine about them. They have to have a life greater than 1 year, and the expense outside of taxes, sales taxes, have to be greater than $500. Then you would do what's known as you capitalize it. In other words, you can't write it off right away. You have to put it on the balance sheet and you depreciate it over time. The third one in there is long-term assets. So these are ones that, for example, you have investments, and you know what? You're not going to sell them. They just depreciate over time, and you list them on your balance sheet on the asset section. And also assets equals liabilities plus equity. The next section is liabilities. Who you owe. The first item on there is, if you have this, a line of credit would appear on there. Any negative balances on your cash position, okay? Then you have accounts payable. These are invoices that were invoiced to you and you owe to your vendors, okay? And you want to look and say, hey, is my accounts receivable greater than my accounts payable? Because if it's not, that means you got more money going out than money coming in. Remember I talked about in and out? That's really important to understand. Okay, going down that list, you also have if you have any credit cards, that's also considered what we call a current liability. Okay, so accounts payable, lines of credit, credit cards are considered current liabilities. What are long-term liabilities? Because that's another section. If you have mortgages of any kind, any loans that are greater than 1 year will appear there as well. Okay, and down in the bottom, you've got what we call shareholders' equity, or the equity section. That would list who your shareholders are, and what would it say in there is what types of shares they have. Then we have things called common shares and preferred shares. And you can read up more about them. Okay, and then there would be retained earnings or deficit. If you've been operating on what we call a loss position, in other words, if your income statement has less revenues than income, that's called a deficit. And that line there is at the bottom end of the balance sheet. So at the top, the first line on the balance sheet is your cash, comes from your cash flow statement. And the bottom line on your balance sheet is what? The cumulative retained earnings or net incomes. So there you have it. And you need to look at these on an ongoing basis to see what's going on. If you don't look at these statements, how do you really know where you are? You don't. And your bank account and knowing the balance in there doesn't help you, especially if you're in a accrual position. Okay, if you haven't collected, if you haven't collected your invoices and you have to pay if you haven't collected your invoices on accounts receivable and you're paying your invoices on accounts payable faster than you're bringing it in, your cash is going down. So that's why your cash position is not a true indicator of what's going on. So I hope this helps you to understand. I'm happy to sit with you and discuss this further. And our goal is to do the bookkeeping and accounting for you so you can have your actual numbers, your metrics. You hear that term? What in the world's a metric? These are metrics right there. Okay. So you know your metrics on an ongoing basis, so you can do what? Make the best informed decisions possible, so that you know on an ongoing basis that you're making them based on actual numbers that you see, and those are the lifeline and the lifeblood of your company, your baby. What this is a financial checkup. Think about you going to your doctor, and your doctor does what? He looks and says, hey, are you healthy or not? And he prescribes, his prescription. Well, these financial statements do what? They are the prescription to the health of your business, your baby. And cash is the milk to the baby. But you got to know how to what? Have more cash than less of it. So you got to know the ins and outs, and these statements do that for you. I hope this helped you. I hope that this will initiate some wanting to know more, and I'm happy to help you. And in this festive season, I want to wish you a Merry Christmas and a Happy New Year. And thank you so much for taking the time to listen to this message and all the other ones as well. I know you can do it. If you put your mind to it and you study your numbers, if you think about it, these are the things that are really important. I don't know if I ever said to you before, but your ability to speak, your vocabulary with your mathematics, if you put those two together, that's how you succeed in life. And that's what this really is your ability to think, right, is based on your vocabulary, your ability to express yourself. And then if you take the numbers side and you apply that to your life, guess what? You're ahead of most people. I wish you well. Merry Christmas and a Happy New Year, and look forward to talking to you soon. Ciao for now.